Hello and welcome to FinextraTV. I'm Hannah Wallace and we're here at Money 2020 in Amsterdam. With me now in the press lounge is Mikkel Velin from YouLend. Mikkel, thank you very much for taking the time out of the busy event to come and speak with us in the press lounge.
Thank you.
Really good to have you here. Now we're talking about embedded finance and SMEs, two really big topics at this year's event. I want to begin by looking back because historically the financial services landscape has proved familiar and frustrating to those small business owners, and that's a story of exclusion. So bring us up to date there with that in mind. What's the story with embedded finance and what's been the impact here?
Absolutely, and super good question. I think I could speak for hours about it, but I'll try to be brief. There's two main drivers here at play. One is a structural shift away from the banks, an unbundling of traditional bank services in the aftermath of the great financial crisis, where traditionally the banks were a one-stop shop for payment provisioning, for traditional banking and so forth. And the financial crisis and the bank regulation coming in the aftermath of that ultimately meant that payment service providers were spun off from the banks and started to build an ecosystem on their own and service merchants. At the same time, exacerbated by COVID, or not exacerbated, accelerated by COVID, you had a structural shift in the acceleration away from physical towards online commerce. And these two things ultimately meant that you had a lot of newer businesses online that didn't fit the bank's traditional models, A, and B, you had a lot of businesses and entrepreneurs who used to be relying on the banks, now not fitting in anymore in the new de-risk bank world, due to size, due to lack of data and so on. And the servicing of those now lies with the payment service providers, the e-commerce platforms, the eBays of this world, Amazon's, as well as the technology companies such as Shopify, Google. Now, in the old days, so to speak, the main financial partner for a lot of these businesses and entrepreneurs were the banks, whereas now almost 80% of the same group refers to their payment service providers, e-commerce platforms or technology companies as their main financial partners. Now, that means that these financial partners have a warm, trustworthy relationship with the merchants. The banks don't service them anymore, not with the speed and relevance they need. Therefore, these platforms and payment service providers are better positioned to extend financing to the merchants than the banks are. Frankly, they don't do it. And that's where we come in. So we enable our partners at YouLend, our partners like Shopify, like eBay, like Dojo and so forth, to extend financing to their merchants, powered by us.
Brilliant. Well, thank you very much for bringing us up to date. Interesting to hear what you're doing at YouLend as well. So where are these new data points coming from and how is embedded finance helping enable these new risk modeling techniques? What about that?
Yeah, what about that? I mean, it's a broad question and it's a good one. The banks traditionally are focused on old data, annual reports that are 1, 2, 3 years old, and ultimately a condensed view of what someone else thought about a business 3 years ago. You could be a bit harsh, and they're not going to be, and say it's aged data points and they're polluted by subjectivity. What we try to do is to find and establish and test live data points to establish the heartbeat of the business in order not to exclude people due to age or size of business and so on. And we use technology to do that and to drive down the marginal costs so we can service an underserved part of the universe. Now, it's important to say that a lot of the merchant bases we serve can also have funding from a bank. They're not necessarily micro merchants, or we do fundings up to 2 million, but we do it faster and we do it revenue based where our merchants repay as they earn, which means that the capital lends itself well to the life cycle of a business. Think about it in another way. The traditional underwriting done by a bank is very much akin to looking at how Real Madrid or Chelsea was doing 3 years ago and say how they're going to do next year. It doesn't necessarily tie up. We try to find something that's relevant and live data points. And that's what we've been successful in doing. Furthermore, what we do with these data points is we use geographically agnostic data points, and that means we can apply the same service across borders and enable our partners in reaching product parity across borders. Now, what does that mean? Ultimately, it means whether you go to Shopify, eBay or whatnot in Germany, in the Netherlands, in the UK, it's the same product. But the credit experience with banks are not the same from country to country. But we've established a platform that enables us to do geographic agnostic product delivery and credit assessment, credit decisioning, and that is what our partners want. And ultimately, we win if our partners win, our partners win if their merchants win.
All right, that's a really positive angle to move on from that. And it's not just the SMEs that are winning, is it? It's the SME platforms, such as e-commerce platforms or payment service providers. So tell us a bit about why that is, though.
Yeah, I think ultimately it's down to the entrepreneurs and business owner using the platform, applying the funding they obtain through our partners powered by us in a way that grows their business. So it's all down to them and our partners being successful in that relationship. But what's in it for our partners? One thing essentially, lifetime value of their merchant base. So when a merchant obtains financing through our partners powered by us, they tend to see their revenue grow by anywhere from 10 to 36% over the next year relative to a peer group of similar merchants that did not obtain financing. So their revenue increases, they grow as a business. Furthermore, they are 50 to 75% less likely to switch away from our partners when they have obtained, are thinking about obtaining, or have in the past obtained financing. Ultimately, that means to lower churn, higher volumes for our partners, which means that the lifetime value of their merchant base increases. And that's ultimately what they make revenue from.
All right, that's really interesting. Mikkel, thank you so much for sharing your insights. And as I say, really interesting to hear what you're doing at YouLend and what makes you unique. But thank you very much. I'll let you get back to the busy event.
Thank you very much. Thanks for having me.